Hello guys, welcome to today's class. Today let us learn about liability. And when you talk about liability, we say that we define liability as follows. Liabilities are financial obligation. These are financial obligations of a business that have arisen from past events whose settlement will lead to loss of an asset in future, or the business offering a service. So what we mean is that liabilities are financial obligations in the sense that these are actually debts. Anything you can call a debt is a liability. So liabilities are financial obligations or debts. In Swahili, we say liabilities ni deni. So in other words, they are debts. That's why we call them liabilities. These are debts. And these debts have arisen from past events in the sense that you must have either borrowed, you must have purchased something on credit, something must have happened for you to have the debt. Then, when you are trying to settle the debt in future, you will either lose an asset or you will either offer a service. And that's what we call liabilities. Let's look at characteristics of liabilities here. Characteristics of liabilities. One is that liabilities are financial obligations. And we have said, in simple words, liabilities are debts. Liabilities are debts. Number two, liabilities result from past events. Liabilities result from past events, and we can also say they result from past transactions. That is, liabilities do not occur naturally. Something must have happened in the past for you to have a liability that you need to settle. Number three, settlement of liabilities. Settlement of liabilities lead to loss of an asset or offering a service. And I would give you an example. If you have a debt of electricity bill, you will either lose cash in hand or cash at bank when you're trying to pay the debt. Sometimes you can also be told to offer a service so that you can fulfill the obligations. You can fulfill or settle the debts. That's all about the characteristics of liabilities. Let us look at classifications of liabilities. So we have a classification. Number one, we shall have what we call current liabilities. And these are liabilities that a business is expected to settle within a year. What we mean is that these liabilities should not last for more than 1 year before they are fully settled. And we can have examples. And the examples of these liabilities include the following. One, we have what we call creditors. Creditors or accounts payable. Creditors, these are suppliers who have sold goods to you on credit. Those suppliers that you have bought goods from on credit are called creditors. And you are supposed to pay them. That's why we call them accounts payable. The other type of a debt, current liability, is what we call bank overdraft. This is whereby the bank allows you to spend more than the balance in your account. For instance, you had an account balance of 1 million, but the bank allows you to use 1.1. That means the extra 100,000 is actually a bank overdraft, where you have spent more than the money you have in your bank account. You are expected to settle that bank overdraft within a period of less than a year. The third one is accrued expenses. These accrued expenses are expenses relating to a previous period that have not been paid in the current period. For instance, expenses for last year that have not been paid in this year are called accrued expenses. You can have an expense like rent. Rent that you have not paid for last year. In this current year, as at today, that rent that you have not paid for last year is accrued. To mean it has piled up, we call it accrued expenses. Those accrued expenses are debts, hence they are current liabilities. And you don't expect those accrued expenses to continue piling up. You are expected to settle them within a year, hence the reason they fall under current liabilities. The fourth one, even though not very common, is what we call short-term loan. These are loans that you have picked or that you have applied for in an organization to be serviced within a year. We call them short-term loans. Loans that are expected to be paid within a year are short-term loans. The other category of liabilities is what we call the long-term loans, the long-term liabilities. And these are liabilities that a business is expected to service or settle for a period of more than a year. That is, these liabilities are expected to last for more than a year as the business services them. The main example of this is the loan. And this loan, I mean long-term loans. Any loan that is expected to last for more than 1 year is called a long-term loan, and this forms the major long-term liability. Thank you.